Hi everyone. This video is going to be about exits because I know it's something that we all struggle with, and um, it's perhaps a part that people are trading now and don't really have a clear definition of what their exits are. So let's um, let's break it down. Okay, so what we know is that in most days we're going to make new highs and new lows in the London and New York trading session. Okay, so if we're taking an entry from the low, I know today we haven't had one. If we're taking an entry from the low, okay, we've got to be expecting price to then make a new high for the day. Okay, so if we entered down here, we'd expect it at least to get up to here. Okay, so this is a good marker for when you want to start trading, managing your stops. Okay, and what that does is it avoids you perhaps reading some price action in here, moving your stop too soon, and then price continuing your way and missing out on a decent win. So as a general first rule, I tend to, if I'm entering a low, I don't look to manage my position until we're making new highs. And likewise, if we're selling from a new high for the day, I look to manage when we're making new lows. So that kind of covers the days where we get a new high and a new low in our trading sessions. But if we look at today, that doesn't help us because we've taken a reverse trade at the high and we're making new highs. So, just using that rule doesn't really give us any framework for this scenario today on the euro dollar. So what else can we use to ensure that we make decent profit? And some of you won't have much data trading this way yet, so you're going to have to use backtesting data. But based on my data, my average winner is 2.5% and my average loser is 1.5%, and that stays pretty consistent. It fluctuates up and down, but I check my data regularly, for the week, for the month, and for all time, and they're pretty consistent figures. So in other words, what we're saying is that taking a big win is there's never any problem with that. If you let all your trades run to big wins, then you'll do okay. But obviously, if you hold your trades indefinitely, a lot are going to come back and stop you out. So what can we use to back that up? Well, if you backtest taking entries at the low and then only exiting when you have an opposite high, then that has a positive expectancy. Okay, so for instance, now in this current trade, it's a reversal trade, but because we're going long, I'm going to have to consider that a low. So if I just hold that trade until we get a short trigger from the high, so for instance, if this bar closed down and I moved my stop for there and then it triggered, if I just do that with all of my entries, I have a positive expectancy. Okay, so I know holding my trades and until we get a reverse signal is going to do me okay, right? At the same time, if I enter here and price shoots up in one bar 100 pips, can I take profit there or not? And I would say yes, because again, if I look at my average large winner when taking a low trade to a high exit, to a low exit, to a high exit, on the euro dollar and the pound dollar, anything over sort of 50, 60 pips is a pretty big winner in that. So if I'm taking profit in that ballpark, I'm kind of basically going along with the data that has a positive expectancy. Okay, if I said I'm going to hold all my trades for 150 pips, and I look back at my data and there's maybe 3 a month that are 150 pips, then you need to consider that. Okay, but trading from high to low, I have a lot of winners around 60, 70 pips. Okay, and I make consistent profit doing that. So if price shoots to more than 60 or 70 pips, then there's no issue with taking profit there. I'm just kind of going along with what my strategy's already doing anyway. Okay. Some other things to consider are, okay, let's say I took this long here. Let's say this bar closed down and a short triggered here, okay, and I took profit on this long. What is going to be my fear? Okay, obviously my fear is going to be that I've taken profit here and I've gone short here, and if price reverses now, I've missed out on that extra profit on my long and taken a loss. Okay, that is the fear. Okay, that's fear of future regret. That's natural. You're going to feel it every time you exit a trade. But what you have to do is say, what's the worst that can happen? Well, if I'm taking a 60 pip win, the worst that can happen is I'll probably continue to, have those figures that make consistent profit. So there's no problem in that. And also, if I do take this short here and close my long and price goes long, what are we going to have? Well, we're most likely going to have a reverse entry. So you get an opportunity to re-enter anyway. Okay, that's the beauty of using this reverse entry is you can basically try at a level, and if we look today earlier on in the euro dollar, we closed down. I had a pending short here. I tried at this level, price reversed, and I get the reverse trade long. You see, so there's always a good frequency of opportunities. Okay, I know I'm going to win half of those because my data agrees with that. I know that if I get wins around 60 or 70 pips, they're the most consistently large wins I get, so there's no problem exiting there. It's just all relying on data basically, rather than on any particular feeling. So if I feel, if we consider this trade now, basically I just have two decisions to make. Do I let it run, or do I take profit? Okay, and both are valid. Okay, because if I let it run and price closes down here, then I take the short and I've still got a win. Okay, if I take profit, it's a big win. It's about 70 pips. That's in line with the figures that I make profit from anyway. There's only really one scenario where I could end up it being the wrong decision, and that's if I let it run and we get one big bar that removes all of this risk. If this closes down and I decide to hedge and leave my long open, if we then get the big bar, well, I'm going to win what I already had anyway. So there's lots of levels of protection for you there, and I think so you just kind of need some sort of basic frameworks to work around, and the only sort of exit I really would kind of advise against, and not just because it's bad for profit, but more because it's bad mentally, is taking early profit. Okay, and so an example of that would be I took this reverse trade here. Because we had this weak bar here, I decided to just exit. Okay, it's not a big win. It's not a triggered reversal trade. Okay, it's just fear that my winner is going to turn into a loser. And I think that's a bad way to go. I'm not saying it's not possible to just take small wins all the time and have a higher win rate, but I don't think that will be as profitable in the long run, because when the market really is in your favour and trending, those big wins can make a big difference to your bottom line. So yeah, that's kind of it on stop losses, and not stop losses, exits for now. If you'd like me to do some more, then I certainly would, or if you want to come up with your own rules and want me to sort of consider them. But the main takeaway is consider your data, look at your data. If it's making consistent profit, then look for that for the answer for where you should TP your trades. Cool. I'll probably do a recap video later, and I did promise I'd do a video on. I promised I'd do a video on the different time frames, H4 and daily, and yeah, that one is coming up soon.